Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know.
First up, U.S. stock futures wavering a bit this morning after equities closed out 2 days of gains driven by optimism about tariff negotiations. Tech stocks led the gains after President Trump allowed for electronic exemptions, but investor sentiment still fragile. The latest Bank of America fund manager survey showing investors haven't been this bearish on stocks in 30 years.
Plus, on the trade front, China is retaliating against the U.S. by halting all deliveries of Boeing aircrafts in the latest escalation of the trade war. Meanwhile, auto stocks are in focus as Trump says he's exploring possible temporary exemptions to his tariffs on imported vehicles and parts to give auto companies more time to set up U.S. manufacturing. But pharma and semiconductors may be next for tariffs. The administration is proceeding with probes into imports of pharmaceuticals and semiconductors on grounds that reliance on foreign production of medicine and chips is a, quote, national security threat, according to a Monday filing.
And bank earnings continuing with results out from Bank of America and Citi this morning. Bank of America stock traders posted a record quarter as the company reaping benefits of volatile markets while net interest income topped analysts' estimates. Meantime, Citigroup inched closer to a key profitability target in the first quarter as the firm's traders also surpassed expectations, and the bank drew a record haul from its wealth and retail businesses.
U.S. stock futures wavering this morning after two back-to-back days of gains, sessions of gains by potential tariff relief here. Now joining us, we've got Omar Aguilar, Schwab Asset Management CEO and CIO. Omar, great to always get your perspective, especially at a time like this where markets are searching for direction. What, from your best calculus and modeling, are you believing for that direction to be?
Yes, good morning. Indeed, I think the level of uncertainty in the market, has reached its peak, and it's sort of in the process of adjusting to figure out, where direction to go. I think equity markets have been volatile, will continue to be volatile. I think this is the typical framework that we see in periods where there's still a lot of decisions that could impact the direction of the market. There will be effects, especially at this moment, where earnings will play a role. But still, the macro environment and trade decisions as regarding to global trade policies will still remain the headline. And the overall market direction may move faster depending on where those things go. We will see days where specific companies will do better because of their earnings release and their earnings outlooks, and there will be others that will obviously be more affected by how these policies. I think investors are looking also at the fixed income market and bonds to try to get a sense of where the global economy is. It's kind of an interesting, in periods of high volatility, usually the bond market tends to be a better barometer of the direction of the economy. And then the equity market seems to be a better way to look at the sentiment of investors. So sentiment and more extrapolation comes usually from equity volatility. The direction of the global macroeconomy seems to be better reflected in bond prices.
So talk to me then about where investors can find opportunity right now in terms of finding places to hide out while the tariff uncertainty unfolds and hopefully at some point for investors gets to a place of a little bit more clarity.
Yeah, well, we continue to engage with our clients in trying to understand this period of time is clearly uncertain. It's unprecedented. We haven't seen these type of situations, for a long, long time. And therefore, there's still a lot of questions in mind. What is actually true, though, is that the long-term investment objectives shouldn't change. The risk profile shouldn't change. And if anything, what we're trying to encourage our clients is to try to just, stay close to the risk profile and try not to necessarily go beyond what they believe is probably just the core set of investments that should play in the long run. I think time horizon is probably the best way to deal with the short-term volatility and uncertainty because, as I said, I don't think the volatility and the uncertainty is going to go away anytime soon. We're still going to have several months until we can actually get a good footing on where the policies will go, and therefore, how companies will adjust. Earnings, are a big driver of what the things will go, but usually earnings tend to reflect what already happened, and we expect that earnings seasons will continue to be, pretty solid. However, it's going to be important for clients and for everybody to look at what the outlooks are for the future. At the moment, we still expect that earnings are still not capturing the full-blown, potential for tariffs because nothing has been set and nothing has been implemented. So what we encourage our clients is to look along term, look at their perspective, continue to de-risk their portfolio and look for opportunities, particularly in areas of international. For the longest time, most U.S. investors tend to be underinvested in international markets. So this is a perfect opportunity for them to rebalance those and try to just get exposure to international markets that tend to provide additional diversification.
Omar, to your point on earnings, I was reading through the FactSet note at the end of last week talking about the number of S&P 500 companies that could potentially withdraw guidance. And this is something that's already started to rear its head early on in the earnings season. Delta, one of those names, of course, as you think about the unclarity and the uncertainty that CEOs are navigating this period with, how much do you think that will prompt many of them to say, we have visibility for the next 60 to 90 days, but beyond that, we don't know how this business can navigate what many of them are calling policy ambiguity?
Yes, we do expect that trend to continue and actually get higher. I think EPS estimates is still for the S&P 500, it's around 11%, which is still pretty high, based on, what the current uncertain markets might look like. And yes, we do expect, CEOs and CFOs to pretty much provide guidance of what they have control, which most likely will be this upcoming quarter. But beyond that, the adjustments to, the new set of rules will still be unknown. What we do know, and something that was most likely coming in most of conference calls that we'll have for each companies, is that they will reduce the capital expenditures. They will still reduce the amount of hiring they will have. So a lot of those is already happening. When we see some of the different projects that have been in place, some of those have been halted, mostly as a result of, companies taking a little bit of a pause, to try to figure out how they will adjust to the new, potential, set of rules. Supply chain, disruptions. It's an area that I believe is probably going to be an interesting way to understand how people adjust to the new global trade policies. We had a great learnings through COVID, but it's going to be interesting to see, and it's going to be industry by industry. It's not necessarily going to be all companies the same way.
And so, just as a follow-on to that, how are you thinking about what the real expectation for S&P 500 EPS growth should look like? You'd mentioned that 11% figure. What's perhaps the more unfortunate reality that we might have to guide towards?
Well, because we don't know the final, structure and the implementation of tariffs. Again, if we go with the baseline of what was presented a few weeks back, the GDP numbers, will probably, be affected between 1.5% to 2%, and that's on the real GDP. What that means is in terms of earnings, just by doing the extrapolation, we'll probably have to come down between 2 to 2.5. Which again, that's just a rough estimate, and it will vary industry by industry, but overall, we do expect that, again, because the cost of inputs and the cost of labor will potentially, be different. I think there will be an adjustments to earnings expectations down the road.
Thanks for working through that equation with us, Omar. Always great to grab some time with you. Appreciate it. On the tariff front, auto stocks potentially spared from tariffs by the Trump administration as the president wants to give more time for the companies to adjust to the higher levies. Joining us now with some key takeaways, we've got Yahoo Finance's own Pras Subramanian. Pras, what do we know about this so far?
Yeah, Brad, maybe some relief here for the automakers. We don't have much clarification. We don't know when Trump said he wants to help out the automakers, if he's going to say, hey, we're going to put a pause potentially on the auto tariffs, the foreign imports of 25%, or if the car tariffs, for the car parts tariffs, that thing coming on May 3rd, if that's going to actually have some relief there. I think a lot of analysts talk about how the car parts, the auto parts, is the most important part of the supply chain here. It's actually easier to bring the manufacturing to this country as long as you can source the parts from wherever. That's the big issue. So either way, the industry needs a break. Potentially, we might hear more about that from Trump, saying that there's a possible exemption here. Because Brad, look at costs. If these tariffs stay in place for both car parts and the actual foreign imports, could raise prices as much as $3,000 for cheap cars to $12,000 for mid-level cars, to even $20,000 for a luxury SUV, EV, that type of vehicle. In terms of lost sales, you could lose about 1.5 to almost 2 million lost sales per year in the U.S. So it's not an insignificant amount. But it's funny, Brad, I'm just hearing anecdotally and seeing on websites different car dealerships selling. Here's our non-tariff inventory. Come and get it, right? So how long does that last? It's funny to see these dealerships sort of using that as a tactic.
It certainly is interesting to continue to see that kind of on-the-ground response to these tariffs, Praz, but we're also getting a global response. And I want to talk to you about the retaliation that we saw from China ordering its airlines to stop accepting deliveries of Boeing jets, according to reporting from Bloomberg. Talk to me about what you're hearing from sources about the impact that could have on Boeing and just more broadly on the airline space if they're continued to be a tool in this trade war.
Yeah, so it's a Bloomberg report that China has ordered its carriers to halt deliveries of those Boeing jets. Not confirmed as of yet, but it seems like that's what's happening here in China. And China's a big customer, all the various airlines, for Boeing parts, and not just planes, it's Boeing parts too. Apparently, the parts are actually the Chinese government saying don't order those either. So that could raise price for Chinese consumers and increase costs for maintenance. So it's a big deal for Boeing stock is down here in the pre-market, and it's because a big market is being cut off from them, and that's not surprising. We knew this something like would happen beyond auto parts, cars, and maybe cell phones. Right, this is the next thing. Is we're going to stop deliveries of Boeing jets, and that's a big problem for Boeing, who's trying to ramp up their deliveries here as we get to Q and earnings coming up in the coming week.
All right, Praz, we got to leave it there. Thank you so much for joining us. Appreciate it.
Thanks.
Big tech stocks under pressure, a bit mixed this morning after getting a big boost from the Trump administration's temporary tariff reprieve for tech products. That sent Apple back above a $3 trillion market cap on Monday. Joining us now with more, Dan Ives, Wedbush Securities Global Head of Technology Research. Dan, great to have you back with us. The last time we spoke, you said these tariffs were causing an economic Armageddon that would set U.S. tech back many years, and now we've got Apple hitting above $3 trillion. Where do you sit with your outlook on tech today, given these negotiations?
Yeah, now is a dark day. I mean, like when me and you and Julie were talking, and I think we're in a better situation today than we were then, because these tariffs, it gives a 1 to 2 month, pause or exemption, whatever you want to call it. And that's also room for negotiation with China. So I think investors are viewing this as kind of breathing room. You're still not going to see any sort of guidance in terms of, earnings and earnings season. But I think this is definitely a step off the cliff relative to where we were the last week.
Dan, I caught a lot of flack from a lot of my followers on that dark day because, look, I was overseas. I was living my best life, or at least trying to, while this was all unfolding, and I'm paying attention to it at night, and I listened into you guys' interview. And even as you're thinking through your coverage universe right now, how many of those names within your universe are still in this twilight zone? Because that's how you titled your most recent note around Apple as well.
I mean, look, if you assume that these ultimately stay in effect, then you never would be bullish on another tech stock, for the rest of the year. I mean, so our view is that it's going to get negotiated to something much more containable. And that's something that tech companies, auto companies, from Tesla to GM, to basically every tech company in the supply chain is dealing with. But the reality is that the industry spoke, the 10-year spoke, the dollar spoke, and they need to come back. They need to come back to some sort of area that they're going to be able to negotiate in terms of the White House. And I think that's how the market's reading this.
And it sounds like you're reading it like these negotiations will take place for tech. To what degree do you think that there's a Trump put in U.S. tech stocks?
I do think there is. I think ultimately If you go back the last 2 weeks, and I told you, look, 25 years doing this, dot-com bubble, financial crisis, COVID, and everything in between. It's the craziest 2 weeks that I've seen in my career. And scariest relative to what it could have done to the US tech sector and still what we're dealing with. But I do believe the market spoke, an industry leader spoke, and there's no alternative. And now I'm not saying, do you still need some onshoring, reciprocal tariffs at some minimal level? Yeah. But in its current form, it couldn't stay in at this pace. And I think that's just the reality of the situation instead of just behind a microphone in the beltway. That this is the reality of what the industry is seeing.
Dan, while we have you, we were just speaking with Pras a moment ago just about one of the other names that you cover in Tesla and how essentially that is going to need to swerve any type of the activity or policy that's coming forth around automakers as well. From your best estimation, does that alleviate enough pressure on Tesla, or is Tesla in a world of its own, especially considering Elon Musk's annexation to the White House?
Yeah, look, when it comes to the tariff issue, they're actually best positioned relative to Detroit Big Three and others, and obviously foreign automakers still impacted, right? And Musk has talked about that in terms of just auto parts, right? And I continue to think the tariff will ultimately, and Pras hit it, I believe will ultimately be finished cars versus auto parts. That'll be a significant difference. I think that's how it ultimately ends up being. But when it comes to Tesla, I think the worry is what does retaliatory look like in China in terms of buy domestic, right? I think that's something that's at play. And they have a pivotal 6 months ahead in terms of, what everything we see in Austin, autonomous, and the build out, but the brand issues that Musk, self-inflicted is dealing with in terms of demand destruction in Europe and the US. And that's why this is a key few quarters ahead for Tesla and also for Musk to make, in my opinion, the right decisions to take a step back from administration.
And talk to me about Apple, another name that you covered, Dan. Where do you see Apple heading from here? And also want to get a check-in on how you're thinking about iPhone prices amid these carve-outs.
Yeah, so look, they're not going to give guidance, when they report earnings. But I think the view is 10% numbers cuts kind of baked in here. I think that's sort of what I would assume. Let's call it maybe 7-10%, relative to demand destruction, uncertainty. Now, look, if those separate tariffs go in, combined with the baseline, and there were no negotiations, you'd be looking at a $2,000 iPhone, and that's massive demand destruction. And that is the key right here: is that you have to assume as an investor, negotiations get down to some sort of manageable tariff rate over the next, call it 2, 3, 4 months. That's how investors are viewing it relative to Apple, but it's also why we didn't downgrade Apple. We didn't downgrade any tech stock. It's our view, this is ultimately something that's going to take place over the next 2, 3, 4 months.
If we're charting this over the past 3 months, as we're looking at this kind of longer term chart that was on the screen a moment ago, Dan, I mean, this is still just a lower high for Apple as they're touching the top end of what that range looks like to the downside. As you're thinking about the technical analysis versus where investors would be apt to buy in and looking at some of the dip buying opportunities that are in the market, where does Apple sit within that?
Yeah, look, and the business model is turned upside down, right? I mean, we're not just talking about things like iPhone demand, AI being pushed. I truly believe, this has now been, what I view is, call it a 10 to 20% overhang in the stock. But you need to see how it plays out for Apple. I believe best case, you start to get back, 250, 260, 270. Worst case, you could go down another 10, 15, 20%, right? I mean, I think as you start to get toward 180, that's where a lot of investors look like it's table pounder time. But the reality is you need to understand the rules of the game, what the tariff issues are going to be and what you're dealing with and what numbers ultimately look like, especially with 2026.
All right, Dan, we got to leave it there. Always appreciate your insights. Thank you so much. We want to bring you some breaking news. Elaine Wynn, a visionary force behind the transformation of modern Las Vegas, has died at 82. Wynn was the third largest shareholder of Wynn Resorts and the largest individual shareholder of the business. She played a pivotal role in shaping iconic casinos like the Mirage, Bellagio, and Wynn, of course, while championing a people-first culture. Beyond the hotel industry, Wynn also served on the board of Activision Blizzard and was a trustee of the Kennedy Center for the Performing Arts. She served on Nevada's State Board of Education, twice elected as its president, and beyond her influence in hospitality, was a tireless advocate for education and children's welfare through her foundation and other leadership roles. Her legacy lives on in the vibrant city she helped define and the countless lives that she touched. Elaine Wynn was 82 years old.
Mark Zuckerberg took the stand in the first day of Meta's FTC antitrust trial, focusing on the company's acquisition of Instagram and WhatsApp. In a 2012 email, the Meta CEO wrote that the company needed to get our act together because it faced competition from Instagram. The FTC argues it acquired the company to establish a monopoly. For more, let's bring in Moselle Thompson, former FTC commissioner and former member of the Facebook advisory board. Moselle, always good to grab some time with you. So, as we're continuing to watch this play out with Zuckerberg and the FTC, what is the reality of what this outcome could look like and how Facebook once again, or Meta Platforms rather, is once again in the position of defending an acquisition of a company that was way, way smaller back then at that time?
I'm glad that you raised that. You know, we all seem to forget at the time that they acquired Instagram was 20 people, and they paid $1 billion for it, and everybody thought they were crazy. So that was a very interesting time. You know, it's interesting. The government has framed this as that Meta bought Instagram and WhatsApp in order to eliminate competition. And because of that those products have become worse for consumers than they could have been, and that the actual market is actually the personal social networking, which is among friends. Meta, on the other hand, has a different version or a different view of what the market is and what they were doing. They said it was strategic. Those products have become better. They still remain free, and that the market is actually much bigger. Friends actually are a very small part of what these apps do and what the market is. And the market is actually much broader in terms of competition with companies like TikTok and X and YouTube, and those provide the real competitive marketplace. So it's interesting that we're also looking at these transactions, not only what they were thinking then, that's not only Meta, but also what the U.S. government was thinking then, but what has actually happened since then. 10 years, over 10 years is a very long time.
Mm-hmm.
Well, it's interesting, Moselle, because you mentioned TikTok, X, YouTube, all competition, but given how similar to the end consumer that those platforms look to some of the Meta platforms, is that argument going to be enough that competition still exists outside of Meta?
Well, I think that it is pretty real. You know, one of the things that I have found interesting in the framing yesterday is that the FTC says that the market is actually smaller than it really is. That if you look at the broader market, Meta only controls 30% of that market. You have all these other companies out there. And I think if you look at it from an advertising space, most advertisers view that market is the larger market. They want to figure out how to get to all of those different segments within the marketplace.
So with that in mind, if this is a precedent-setting case, then who should be on high alert next? Because there are a lot of these other companies, too, that are on screen right now that have made some very lucrative acquisitions that have been able to essentially find synergies, be able to grow out and scale the businesses that they've acquired higher when they are finally fully kind of making the deal consummated at the end of the day.
Well, it's unprecedented in a couple of ways. One is it's rare to have a possible remedy like divestiture. It's rare to do that after the agency actually made a pass. They actually ruled on this transaction over a decade ago. In addition, that the technology industry is iterative. They build on other technologies and ideas of others before it. And the acquisition of other companies and hiring of other people have been an integral part of what innovation has been about. So does this mean that that anytime a company goes through the process of acquiring additional innovation, that they'll be viewed as a lens of competition? So it's a very interesting new territory. And this would be unprecedented if we're to go in that direction and possibly send a pretty chilling effect throughout the industry.
Mazel, we've got about 30 seconds left. Just curious how you're thinking about what regulation is going to look like under this administration. There was a lot of hope from Wall Street about deregulation, but then the Trump administration said they would mirror Biden-era regulatory practices. Where does that leave things?
Well, at this point, they've done a couple of different things. One is they've continued their enforcement actions in the antitrust area. But what's interesting is how they've done that. They've also the executive have taken control, and they've been very clear about that in their executive order, of these agencies. So they're not independent anymore. They report to the executive. In addition, that the FTC has also fired the 2 Democratic commissioners, so that there's no possibility of dissent within the actions of the agency. That we have never seen.
Right. All right, Moselle, great context there. Thank you so much.
Thank you.
We'll have all your markets action ahead. Stick around for the opening bell on Wall Street. You're watching Morning Brief. That is your opening bell on Wall Street. Let's do a quick check on the markets here. The market's up 2 days in a row for the first time since April 2nd, what the president would call Liberation Day, the day that those so-called reciprocal tariffs were announced. Will we continue to see a market moving into the green today? At the market open, it is not looking like that. I'm just going to take a second to let our markets boards adjust behind me here. But let's take a look at the bond market really quick, because we are continuing to see just a little bit of a sell-off here with yields moving to the upside. Perhaps that is a signal of a risk-off sentiment taking hold in our market today here. But it does look like at the current moment, I'm seeing green across the screen. That may again be, we are seeing green across the screen this morning. You've got your S&P 500 up just about 0.2%. Your tech-heavy NASDAQ barely above the flat line in the futures market. We were hovering back and forth between red and green in your futures here, but still looking like you've got gains so far this morning. And of course, financials being one of the biggest gainers on a sector basis in your S&P 500 off the back of the close of those big bank earnings this morning. Let's get it over to Yahoo Finance's Jared Blickery for a broader look at what's moving. Hey, Jared.
Well, thank you, Maddie. I love how we're celebrating 2 up days in a row, and it does seem like we've just had this everything up, everything down, back-to-back days, going back to the beginning of the month. Interestingly, over these last 2 days, we did have participation to the upside over 85% of S&P 500 components. So it might sound good, like everything's going up at the same time, but unfortunately, this just shows you that most of the correlations have gone to 1 or -1, and it's not necessarily a healthy market when everything is moving in lockstep like that. I have a year-to-date chart of the S&P 500, and I'm drawing in a line here that the S&P needs to cross, and in fact, it needs to get above all of this consolidation that we had in March in order to have a shot at record highs again. And this is just going to be difficult. I'm going to compare it to Apple in a minute here, but I got to move on to the VIX, and we can plot volatility. Very briefly, the VIX dipped into the 20s here, and you can see it has indeed been coming down. We want to see that trend continue to support stocks, but as long as it remains above the 20 level, and that's just somewhat arbitrary, that's still pretty risk averse. Looking at the 10-year T-note yield, we are seeing a little bit of consolidation. It's almost impossible to see today's candle, and it's a very similar situation with the dollar. Also not seeing a lot of action in the commodities. I'll get to that in a minute, but I think today is just kind of a quiet day where we're seeing a lot of this consolidation of these extremely frenetic recent moves here. And then checking in on the sector action, let's see, we got a split screen here. Financials and tech, that is number 1 and number 2 here. Financials almost up about 1%. Consumer discretionary down 0.25%. Consumer staples down 0.1%. And so the consumer sector is not doing that great this morning. Want to move on to the NASDAQ, where I'm looking at Apple here specifically. Apple had an interesting day yesterday. I'm going to show you a very similar chart to the S&P 500. And in fact, Apple climbed into this territory. I'm not drawing these lines very well, but it climbed into this consolidation area yesterday, and it was firmly rejected. We need to see not only climbing into this area, but above it and beyond. And that's going to signal more risk on for the rest of the market. Having said that, it looks like a nice green day, a lot of participation to the upside. And then we move on here to, let's get to some futures action. I did mention that things are pretty quiet in futures land, but notably gold is up about 0.33%. Looks like another record high. And this is a year-to-date chart up 22%. And you can see this little spill, while the rest of the market was going down quite a bit more, was easily reversed in just 3 days. So gold looking strong here. Copper has been volatile as well. It is, its daily range is now greater than yesterday, but you can see just had this huge move where it fell off, and now it's trying to find its footing. Are the bulls going to win? The bears going to win? It's just kind of a theme that we've seen weaving throughout the entire market. I will close on crypto, and Bitcoin has been using 85,000 as support, and this is another year-to-date chart where it's down 9%, but 85,738 is where we are right now. It is broken out of this negative trend line, as you can see there, but there's been really no catalyst to make it go up or down, and so that's where we kind of are with the markets right now. It seems like we're just waiting for another catalyst, hopefully not a shoe to drop. Brad?
Exactly. Jared, thanks so much. Appreciate it. It's time now for today's strategy session, the latest Bank of America investor survey showing some of the most bearish sentiment on record. But Wall Street strategists still expect the S&P 500 to close out the year higher. So, what are the drivers to close out the year in the green? Joining us now, we've got Tom Hanlon, who is the U.S. Bank Asset Management Group National Investment Strategist here with us. Good to have you. First and foremost, let's just run through some of the bottom line stats that they posted at the top of this Bank of America April Global Fund Manager Survey. 5th most bearish fund manager survey in the past 25 years. 4th highest recession expectations of the past 25 years, and record number of global investors intending to cut U.S. stocks. With that as kind of setting the table here, Tom, where do investors turn right now?
Hey, good morning, Brad. And I think it's not surprising to see those survey numbers because we're just in a different world post April 2nd. You know, prior to April 2nd, all that economic data and those corporate earnings results really were kind of figuring into what the trend of market prices would be. Now it's really about what is the ultimate policy goals of the administration and getting clarity on the end game there. And that would allow perhaps the markets to break out of that trading range that you referred to earlier. But, you know, we're talking with clients and other investors and just looking at them from a perspective of kind of where they are in their financial journey and helping them kind of get towards where they ought to be in this environment.
And you talk in your notes that you sent over to us about how it's not really about earnings, company forward guidance, or even economic data. It's really about clarity when it comes to tariff policy. How are you thinking about what the road ahead to getting that clarity might look like and how much pain could be ahead for the market as we await that clarity?
Yeah, Madison, I mean, we envisage like 3 basic scenarios. And right now, the base scenario is we're in this extended period of negotiations where perhaps tariffs settle into something around 10 to 20% on an aggregate basis. And that process kind of, we think, keeps markets within a kind of a trading range where we find ourselves now. In order to break out from that, either you get resolution on that or you get perhaps the administration achieves some of the goals that they're looking for earlier, and that would allow you to go back to making decisions as a business about what you're going to do with CapEx. I think the positive thing about the economy and the environment right now is consumers are holding up incredibly well, and that's because they came into this with relatively strong balance sheets and solid income statements to support spending.
It seems like that's one of the next shoes to potentially drop, though, Tom, even as we're thinking about where consumers are reading through the headlines. They're not stupid. They're trying to get around, of course, their own finances and their own investment strategy at this juncture. And so if there is a perhaps downturn in the consumer mindset, and then additionally here on the employment situation where companies are trying to figure out what their operational structures look like. That seems like the two-pronged approach that's the perfect headwind for the Fed.
Yeah, and Brad, that's the scenario where you get that sort of kind of worst case outcome. But consumers may be upset about inflation levels that they respond to in surveys. But if you look at their savings rates, you look at their income, they're getting nominal increases of 4% in a 2.5% to 3% inflation world. And I think their confidence is really based on, as you mentioned, that labor market confidence. And it's still a tight labor market. But Brad, if you do see sort of seizing up in corporate activity and perhaps not a willingness to fill those open jobs, if the consumer no longer has that confidence in the labor market, that's where you see spending intentions change materially, and you get into that vicious cycle that can lead you into that recession scenario.
So talk to me a little bit more about the opportunities that you see for investors. You talk about how a lot of investors went into 2025 over allocated to tech. What do those investors do next?
There's opportunities in all markets, and this is a great opportunity to take a look at diversifying those. Those are still fantastic investments in U.S. large cap tech, but as you highlighted earlier in the program, dividend paying stocks are only down 2 to 3% this year. You've got foreign equities, which was kind of almost like a dirty more than 4-letter word over the last couple of years. They're up 5% year to date. So there's opportunities outside of just those U.S. large cap tech. And then if you go into the bond market, there's parts of the bond market that are still delivering both positive income and total returns this year. They're also great diversifiers as we await more clarity on how the policy outcomes eventually unfold.
All right, Tom, thank you so much for the time. Appreciate it. Coming up, market volatility giving bank earnings a boost. We're breaking down what's next for financials as earnings wraps up for the big banks. You're watching Morning Brief. Bank of America and Citigroup topping first quarter expectations. Bank of America boosted by stronger than expected net interest income and trading revenue, with revenue from trading equities up 17% from a year prior. Citi also benefiting from market volatility that generated higher fees for its trading business. So joining us now to discuss, Saul Martinez, HSBC's head of U.S. Financials Research. Saul, great to have you with us here. Talk to me about your reaction to these results this morning and how you're viewing the entire financial sector off the back of these big bank earnings.
Yeah, thank you for having me. I think in the case of Bank of America and Citigroup, they're both very encouraging results. These are both stocks that we are recommending. And I think what in both cases we're seeing is a reiteration of the financial outlooks that we were expecting. So in the case of Bank of America, for example, a big part of the bull case is that the net interest income outlook is very encouraging and that you would see growth throughout the course of the year. And the guidance is for that growth to that net interest income figure to reach 15.5 to 15.7 billion by the fourth quarter. That's a pretty big increases versus current levels. And they reiterated that guidance. And not only did they reiterate that guidance, they had very good core trends in a lot of in a lot of realms. Deposit costs came down. They're actually seeing better than peer loan growth. They're seeing good deposit trends. So the underlying trends that sort of reinforce the investment thesis for Bank of America, I think were really reiterated by the results. In Citigroup's case, and we haven't, their call will be at 11. I think, similarly, they reiterated the full year guidance for revenues and cost. And a lot of the core trends were actually very good. This was a subdued quarter for investment banking, for example, for a lot of companies. Actually, Citigroup outperformed on investment banking. They're seeing good momentum in wealth management. Net interest income is growing. The expense number was good. So, first blush, I think a lot of the underlying trends are encouraging. And I think the other thing I would just mention here is that coming into the quarter for all of the financials, we're really focused on what the message from management was going to be. Was the tone going to be confident or were concerns going to be expressed? And broadly speaking, the message has really been that the sky is not falling. There have been some nuances here, Jamie, maybe a little bit more, in the realm of highlighting downside risk, but generally a pretty nuanced view where they're indicating corporates are delaying decisions, But there's optimism about policy clarity later this year, deregulatory agenda, tax cuts being extended, and folks are still spending in early April. So, the sky's not falling has been the message, and I think that's been well received.
Sure. Saul, as people are looking across the Yahoo Finance platform and comparing some of the financials for these businesses, and you mentioned what JP Morgan's Jamie Dimon was talking about, and considerable turbulence, I believe, were his words. Wells Fargo's Charlie Scharf even talking about some of the downside risks to the economy. And then even as we were looking through Bank of America's release today, we had seen Brian Moynihan talk about some of the potential facing a potentially changing economy in the future. How does that all translate into what investors should be watching for the existing makeup of diversified kind of financial segments that these companies report on?
Yeah, it's a good question. I think, how would a downside case scenario really, play out for banks? And what are the things that we would be looking for that suggest that, things are not moving in the right direction from an economic standpoint. I think that the thing that would really hit the banks, traditional banks, is if you started to see the credit indicators worsening, especially on the consumer side. And that would manifest itself in higher delinquency rates. That would manifest itself in higher net charge-offs. Banks would start to provision more, try to get ahead of it by reserving for future losses going forward. And you saw a little bit of that with JP Morgan. JP Morgan, increased their reserves $1 billion for the potential, for potential worsening and a greater weighting of a potential downside case scenarios in their models. But thus far, what you're actually seeing in the numbers isn't that. Credit has been pretty good. The other things to look at, obviously loan growth would suffer, and that has already been subdued. You would see less demand. You'd see lower volumes, lower spend volumes in the credit card and debit card spend for banks. And it would also manifest itself in investment banking, and you already are seeing that part of it, where corporates are not necessarily or delaying decisions. In that, there you are seeing more of a hit, and you are seeing numbers come down for investment banking expectations.
Yeah, we got about 30 seconds left, so I want to end there. Is M&A deferred or delayed, according to big banks?
Yeah, it depends on whether what we're talking about plays out in the downside, right? If you get more policy clarity, if you kind of get past the concerns about tariffs and it really doesn't upend the economy in a substantial way, it would be a delay. But we're waiting and seeing, right? And it really will depend on whether the tariffs lead to substantial downside to the economic backdrop. And if it does, then those delays could persist for some time.
Saul, thanks for breaking down these banks with us. Appreciate it.
Anytime.
We've got all your markets action straight ahead. Stay tuned. You're watching the Morning Brief. We're taking a closer look at some trending tickers this morning: Boeing, LVMH, and Netflix. First up, China ordering its airlines not to take deliveries of Boeing jets amid an intensifying trade war with the U.S., according to Bloomberg. China is also asking its airlines to stop any purchases of equipment and parts from U.S. companies. President Trump's tariff campaign has resulted in 145% levies on Chinese goods, while China has retaliatory tariffs of 125% on American goods. People familiar with the matter, they say the Chinese government is figuring out how to provide assistance to those airlines that do lease Boeing jets. This is yet another problem for Boeing, which is struggling to recover from a number of setbacks, including last year's door plug blowout on a 737 MAX 9 jet.
Plus, luxury goods company LVMH is falling after reporting weaker than expected sales weighed down by sluggish demand. Revenue in the first quarter fell 3% from the prior year on an organic basis. Fashion and leather goods, the firm's biggest division, saw revenue declining of 5%. RBC writing in a note that investor concerns around underlying demand recovery will likely be amplified based on the results. Hermes, maker of the Birkin bag, briefly had its market cap surpassing LVMH's, making it the world's most valuable luxury company. The whole luxury space struggling with demand issues, including weak sales from China and the U.S., but now tariffs could further weigh on the sector. LVMH's CFO saying they will consider price increases to help offset tariffs.
Finally, Netflix is rising after the Wall Street Journal reported the streaming giant is looking to double its revenue and reach $1 trillion in market capitalization by 2030. Wall Street is bullish. BMO Capital Markets writes these ambitious goals are achievable given a best-in-class leadership team. KeyBank also calls the targets reasonable and notes the implication of larger contributions from monetization initiatives like advertising. And Jefferies notes that Netflix should prove resilient against a tougher macro backdrop. Netflix is due to report earnings Thursday after the bell.
And a programming note, tune in today at 4 p.m. Eastern for an exclusive interview with U.S. Treasury Secretary Scott Bessent and our Yahoo Finance executive editor talking about trade, tariffs, the economy, and more. You won't want to miss the conversation today at 4 p.m. Eastern. That's going to do it for Morning Brief. I'm going to do a quick check for you on the markets here. You've got all three major averages moving to the upside, carried in part by big tech. Join me next in Catalysts.